Welcome to week 4, module 4. We're going to talk about gift tax. Our first 3 modules were concerned with really defining what a gift is and how it's gifted and some of the advantages of gifting. Now we're going to get into the tax part. From many respects, people get the idea after hearing what we're going to talk about, hey, this isn't that hard. Where in real life it can become very complicated, very complex, and should not be done unless you've got the due diligence requirements, the training and experience. I used to know a lot of people who did gift taxes after having their liability insurance go up substantially because of the problems involved. They got out of gift tax, and I think that a good way of taking a look at it is in week 4 in the information reference documents we have on the website for the week. There's an article about some of the problems of doing gift tax, which goes beyond the level of this course, but I think it's very useful for why there aren't more people doing it and the complexities of it. So let's get into it. In theory, the preparation of the gift tax is easy. However, few qualified tax preparers really understand complex gifting strategies usually associated with gifting. In other words, people get extremely creative. And we saw some that I consider very creative, like the lease back, the private annuity, the self-canceling installment note, but there's so many more involved. Also, we have to face the fact that generation skipping tax is oftentimes a problem in this area, and that is a very complicated area also. So the complexity of the strategies, the complexity of the generation skipping tax probably makes it something that most people who do taxes stay away from. Gift tax return number is 709. You might want to take a look at it. We have it in our reference informational section for week 4, and I think it was the latest form is in there that I could get a hold of. Due to an attachment, it's due as an attachment to the personal income tax return for gifts to the previous calendar year. So when we do our income tax return, we attach our gift tax return to it. If there's a joint return of a husband and wife, and they both gave gifts, both of them have to have a gift tax return. So there's the income tax return has 2 attachments. If you pay it after April 15th, there's penalty and interest, which means that even though you aren't filing your income tax return by April 15th, just as with the income tax, you will pay penalties and interest if you haven't paid the appropriate amount of tax for gift tax by April 15th. So payment is always due by April 15th, although you really have till October till you have to have the return in. And many of your clients are going to be in a position where it will take August, September, October before they're really able to submit the return. And as I mentioned before in the class, I always guess high is what the taxes will be. The reason is, then when they get money back, they're happy with you. But if you understate it and they're going to come up with more money in October, plus penalties and interest, they're not going to be very happy, and you're going to lose a client. The return must be filed even if no taxes are due, unless the gifts are to spouses or charities that are qualified. And unfortunately, because of the control freaks, many of them don't give gifts to charities and spouses that are qualified. So they're going to have to fill out the return in their cases. And then that's under the annual exclusion. We can also get out of doing it. But if there's one value for that $1, for example, of future interest, it's going to be taxable, and you're going to need to fill out the tax return. And the way I put it is, once you fill out a gift tax return, you're going to have to keep track of it every year thereafter, because again, it's a cumulative tax, and it's subject to recalculation every time you make a gift tax return. Some of the unique features of gift taxing: it's a cumulative tax since 1976, so we have to take into account all gifts made since 1976, and again, people are terrible record keepers, and therefore that isn't the easiest job in the world, and many times we need to get forensic accountants involved. We get annual exclusions for gift of a present interest to individuals without being taxed, and again, that's the individuals. not the entities, not the trust, but the individuals are the only ones who can get the annual exclusion. And that is a mistake a lot of people make. They think they give a gift to Mr. and Mrs. Jones. Well, it's not an individual, it's an entity. There is gift splitting for spouses. Gifts to spouses and charities are tax-free if qualified. And again, control freaks not always make it qualified. Tuition payment of medical expenses and political contributions, if done correctly, are tax-free. Excuse me. Calculating the tax. First of all, we gather a list of annual gifts. We determine who the recipients are and how much they got as far as fair market value gifts, so that we have gifts by person. We determine the total value for the year. We do a gift split if applicable. And in other words, it's married jointly decide that there will be a gift split. We deduct the annual exclusions if applicable. We deduct the qualified, meritable, and charitable. We determine the taxable gift value for the year. We add the taxable gift values for all previous years to that value. We determine the tentative tax using the tax rate for the cumulative taxable gifts. We subtract the cumulative tentative gifts paid to date, and the remainder is tax due for this year. Sounds very complicated going through here, but it actually is relatively simple. Once you sit down and work on it, I might suggest you look in your textbook, and there's several good examples. And that is the end of what we have here. Again, it's a very straightforward information.